from a 5% growth last year in 2024 to about 5.2% for this year. So that's also a good print, and hopefully that will spur on the risk-taking appetite across the clients as well as the global risk, as well as the global investor space. Um, Probably I will skip the black swan events. I think I will use leopards later. Yeah. And I think probably if we are still calling for rate cuts in 2025 by the Fed, I know that the markets is actually calling and the consensus is about one rate cut this year. We refuse to move. Yeah. We refuse to move because we believe that the current pricing of the Fed funds rate at one cut has completely assumed higher inflation pressures as well as Trump injecting the tariff measures into 2025. We have not seen that. The entire economic space, I'm an economist, and I refuse, at least at this juncture, to react purely on political noise, policy noise. And this is something that I would need more clarity and hear from Donald Trump when he comes in and moves in into the White House on the 20th of January. I need to wait for that information before I can make a more qualified forecast on the Fed rate cuts. But given what we have right now, the evidence is basically showing slowing inflation pressures, as well as a fairly resilient global growth. And with inflation pressures, at least in the US, moving towards 2% as we speak, that basically suggests that the Fed has more room to cut. That's why we are still calling for 3 rate cuts for this year. And the first rate cut will likely be materializing as early as the second quarter of this year. Yeah. So because of this, our key conviction idea, and outlook will be for the dollar to actually weaken towards 103. Yeah. Currently it's about 109 for the DXY, about 109. It will weaken further to about 103 towards the fourth quarter of this year, purely on the basis of rate cuts, as well as investors reacting to the yield chasing behavior away from the US and probably into ASEAN as well. Yeah. And for our Malaysian colleagues, we are hoping that probably ringgit will average about 4.4 in the first quarter, at 4.3, 4.3 in second and third quarter, and finally to about 4.2 at the end of the year. And that will essentially, be on the basis of rate cuts by the US, as well as the improving domestic indicators in Malaysia itself, like the fiscal consolidation, as well as the high growth prospects that Malaysia will likely be seeing in 2025. Okay, so let me just present our proprietary models once again. I believe that some of y'all may have seen this, but let me just reiterate. We have built a global risk sentiment index for the bank, and this has actually given us a very, very strong indicator to tell senior management as well as valued clients such as yourself on how investors globally are seeing the global economy. Yeah, how confident are they? Any print, and we can see about the blue line, the RHB sentiment index, the blue line, any print above the zero handle, if you see my mouse above the zero handle, yeah, means that investors are moderately to severely bullish. Yeah, and anything below zero means that they are risk averse. Yeah, we can see that when there were risk aversion back in 2019, as well as during the COVID years, whereby the risk sentiment index dips below zero, there were episodes of a very severe pullback in the S&P index. And S&P index is also a proxy of how risk-taking people are, yeah, the US equities. Where are we now, more importantly? Yeah, and this basically sets the stage of why we still think that we should still be moderate risk-taking, and that is on the basis of the risk sentiment index, whereby it's still above zero, very close to 1. It has breached 1 previously, and now it's going back up. Yeah, I think what is important is that there were recessionary fears and concerns during the early period of last year. We see that the recession pressures in the US, yeah, in the beginning of last year was actually quite high at about 70%. The probability is about 70% of a recession, and this is actually very well. It actually coincides very well, in fact, with the risk sentiment index that my team has built for the bank. But more importantly, if we just dwell into the high frequency numbers by the US, what has happened in the past probably can be used as an indication for the future. And how is this behaving? We can see that the numbers in the US have improved very, very significantly since the early part of last year. And in fact, the recession pressures have declined rapidly to about 40%, 50%. You may argue that it's still high, but I think what's important is that it has declined. At least the recession pressures has declined purely on the basis of the improving numbers that were seen in the US, probably maybe excluding the housing market, as well as loan growth here. But generally, the broad idea, it's that the numbers are improving, and that suggests that risk-taking behavior may still continue into the short term. So we will continue to extend our strategy, our asset allocation strategy into 2025. We have seen, that at least in 2024, and these are 2024 numbers, we have seen that the developed market equities were the top performer. Yeah, I mean, ex Singapore, but we've seen Nasdaq and S&P right on top. Yeah, we can also see that Malaysia has also done very well. MSCI World has also done very well. And of course, the ringgit was the best performing currency, in 2024 across ASEAN. And why is this important? Is because at least the expectations of the ringgit remains to be quite anchored at this juncture. The current weakness in the ringgit, it's most likely than not a dollar story. Yeah? So let's not worry about the weaker ringgit at this point in time, because the weaker ringgit is also it's moving together with the weakness across the ASEAN currencies as well. Ringgit is not isolated in the weakness. So let's not be too fixated on the weaker ringgit, but let's just cheer on how ringgit has performed very well, in fact, in 2024, and that essentially means that at least at this juncture, developed markets are improving. Across ASEAN, we think that Malaysia will be a key beneficiary. I will talk about it later, from the US-China trade tensions. So I think for now, let's just look at what fund flows are telling us. Fund flows are actually telling us that markets are still moving their funds into DM equities. We can actually see that DM equities, the black line on the left chart, has been very, very strong. And that essentially means that it basically reinforces our view for DM equities to still remain to be a top performer, at least in the first quarter of this year. EM equities has taken a downside, purely due to China, and I'll show the charts later as well. There were a lot of concerns within the investor space on China, and this is for good reasons. Because towards the end of last year, probably market starts to wake up and starts to realize that look, Donald Trump is coming to power. The tariff rhetoric, 60% tariff against China, is maybe a reality, and that could mean a very huge growth drag on China. Essentially, this also brings up the point whereby the pessimism on China has led fund outflows out from the Middle Kingdom. Yeah, bonds is unexciting. Yeah, you can see it's red tame and not much of a story there, but the equities is actually a very nice story to tell. And of course, good news as well, and I'll go very quickly on this because this is just numbers. Exports has been very well anchored in ASEAN, even towards the end of last year. The manufacturing performance across ASEAN, including Malaysia and Indonesia, has also been very, very anchored. PMI slightly down towards the end of last year, but let's not be too concerned about this because probably it's seasonal. Manufacturing activities in ASEAN, more so across the world, have generally eased into the end of last year simply because of festive cheers. Yeah, into November, December, people start to celebrate December, Christmas, New Year. People looking at the Singles Day, and towards the end of the year, New Year. It's natural. To cut a long story short, for the manufacturing momentum and activities to actually slow down towards the end of last year. I think let's watch for slower commodity prices as well. And this prices itself has actually caused the inflation pressures across ASEAN, and not only ASEAN, probably across the world, including US, to actually fade lower. And this is probably going to be the next key story in 2025, whereby easing inflation pressures into ASEAN, despite the tariffs, is going to be likely to be seen, and I'll explain why later. So I think let's just move to the growth forecast very quickly. So in US, we are calling for 2%, probably upside to about 2.5 based on what Trump is doing. We're also looking for China about 4.5 to 4.8 for this year. And for the rest of ASEAN, I think it's a very nice story to tell. This is assuming that ASEAN flies under the radar when it comes to the US-China trade tariffs, and ASEAN is probably left isolated away from the tariff, impact. And this basically suggests that the growth rates whereby we are going to see investments and manufacturing activities to move away from China into ASEAN. This is going to, benefit at least at this juncture for ASEAN. Indonesia is from 5% last year to about 5.2. Malaysia is flat, 5.1, 5%, very strong numbers. Singapore, for those who have exposure, 3.4 to 3%. And of course, for our coverage, Thailand is also going to accelerate from 2.6 to 3. Essentially, this means that we are not even looking at a soft landing. We are continuing to see essentially a continuous resilience growth, at least across ASEAN as well. Inflation is boring, yeah. As I said, slower inflation, probably less of Malaysia, because Malaysia, we're looking at RON 95 rationalization, we're looking at fiscal consolidation, and probably about maybe higher prices due to policy moves. And that means that, but it's still going to be tame, yeah, 1.9% last year, 2.4% this year. Essentially, it still remains to be very manageable. And that essentially means, for that matter, that BNM will likely stay its policy rate unchanged at 3% for this year. The Fed, as I said, 3 rate cuts for this year, probably 4.25 at the end of last year, will be moving to about 3.5% this year, 3 rate cuts. Yeah. And of course, the FX forecast, whereby because of the rate cut cycle by the Fed, DXY, and this is actually against consensus. Consensus looking for a more expensive dollar. We are not. We are calling for a weaker dollar, but 106, 108 to 106 to 108 for the first quarter of this year, and it should fade lower to 103 when market starts to account for the rate cuts. And this will bring about appreciation across the ASEAN basket. Yeah, for Indonesia, we are looking for about 15,500, 15,400 ringgit. We're looking at 4.2 at year end. For those who have Sing exposure, 1.3. Okay, so now let's look at the leopards. We have spoken about good news. Rates are high, hopefully, now that we are in the new year. But I think what is important is we have to remind ourselves what Trump is going to do in 2025. And let's just move away from the slides, because this morning I have just published a report, and this is essentially a scenario analysis. I think you guys are in for a good time, because this is just fresh out of the press from our RHB printers. We have priced in a realistic hope scenario, base case 60%, on how this Trump and tariff and geopolitical tensions is going to happen. So let me just walk you very quickly through this. Yeah, look at the realistic hope, base case 60%. We think that the tariff measures, if it's going to happen, it's going to be implemented on a gradual basis. Yeah, and I think at best, probably about 30% tariff, not 60%, 30% tariff. Why? Because Trump and the policymakers in the US probably may be wondering on the retaliation risk by China, and hence probably a 30% tariff for this year instead of 60% could be a more realistic assumption. For geopolitical tensions, we are hoping for Russian-Ukraine war to dissipate with ceasefire, and NATO to consider Ukraine's membership, and for the Israel-Palestinian conflict to actually dissipate through ceasefire, yeah, for this year. For the US, we hope, yeah, that the US, Greenland, Panama Canal, Canada, it's merely a war of words. Yeah, there's not going to be any military intervention. It's just arguing here and there with no real consequence, whatsoever. And this brings about the impact, yeah, to across the globe. US steady growth about 2 to 3%, biased towards the midpoint about 2.5. China, they will engage in supportive monetary conditions, as well as growth to actually about slope about 4.5 to 4.8, as I mentioned just now. ASEAN to probably fly under the radar. I think the risk at this juncture is for ASEAN to be labeled under the blackest of swan scenario to be labeled as a China supply route. That is the risk whereby if the US starts to label ASEAN as a hub for China to rebatch its exports out from ASEAN into the US, then if there's going to be sanctions, then probably this scenario won't hold. Yeah, but if you're assuming that you'll fly under the radar, this basically means that the fund inflows into ASEAN, the manufacturing and investment flows into ASEAN, away from China into ASEAN, could benefit very strongly Vietnam, Malaysia, Indonesia, and Thailand. Global inflation is going to probably moderate lower on ASEAN basis due to lower commodity prices. Why? Because in US demand is going to fade, yeah, for global goods. And this essentially means that the commodity prices finally start to sell, away from the US into ASEAN as well. That means that prices across ASEAN is going to fall. Maybe not so for the US. I think for the US, essentially, it's going to pick up higher, yeah, and that could mean about maybe 3% if that is going to be, a tariff measure. Last but not least, probably just FX and current and interest rates. The Fed is going to cut about 2 to 3 times based on this. Trump was still likely going to influence the Fed, probably than not, to cut rate despite a inflationary environment, and that could also mean that the global rates are going to fall in tandem, and for the FFR cuts, as I mentioned just now, to actually move in and weaken the XY to 103. This is the realistic hope. Hopefully, fingers crossed, it's going to happen. But the blackest of swans essentially is going to be what markets will be looking at very, very closely. What if tariff is actually 60% or higher? What if tariff is 20% on the rest of the world and China retaliates? What if the Russian and Ukraine war intensifies? What if there is going to be escalation of the Israeli-Palestinian conflict? Yeah, or if Trump uses military intervention against Greenland, against Panama, and that also could mean the intensification of geopolitical tensions. And the impact is going to be more recessionary than not. Probably US growth will slow very, very sharply to about 0 to 1%, bias towards the downside. China's growth is going to be very, very weak. Yeah, we are looking for a 200 basis point reduction in China's growth to about 3%. ASEAN will be labeled as a supply route, and this could mean that the growth, the boost to growth, so to speak, from the trade tensions is going to fade. Yeah, and GDP growth across ASEAN as a region should plummet to less than 2%. Inflation is going to be very, very high due to the supply chain congestions, and the Fed may not cut at all if that happens. Yeah, and of course, with that, the DXY will rally faster than ever to about 115. Why do I spend a bit of time on this? Is because we think that the current pricing in the markets right now on the rate cuts, the number of rate cuts about 1, and the very strong DXY that you are seeing right now is basically painting a 30% risk. What if this happens? And hence, I think due to pessimism and due to the what if scenarios whereby markets are actually pricing in, that essentially gives a sense that why safe haven demand into the US dollar is actually flowing into the US and actually supporting the dollar at this juncture. Okay, now let's go back to the slides at hand. Yeah, so I think what this is basically a very, very, very quick summary of what Trump may do. Yeah, and this is Leopard 1. So Leopard 1, as I mentioned, the impact to the US inflation is going to be very stark. This is a list of products, the top 18 products that the US is that the US is importing, and that basically shows that if you just do the numbers, I will spare you the calculation. The numbers alone suggest that imports from China accounts for about 13.7%. That's around up to 14%. Yeah, 14% of total imports is just from China alone, and that is very, very. That's a very sizable, part of portion of the imports, and the rest of the world is about 84%. If we are just going to assume full spillover effects from the tariffs into the US inflation, this will mean actually an 8% increase in prices, assuming no quantity change. Yeah, and our models, the thematic report that I just wrote is already published. You guys can have a go at it. If you guys don't have a copy, please reach out to our fellow sales team. We will be very happy to push the report to you. But essentially, if we are going to assume for quantity change, the US inflation will rise to as high as 4%. Yeah, and this means that the inflation pressures in the US is going to be very stark due to the Trump proposals. Leopard 2, if this happens, then the rates may not fall as fast. Yeah, we are calling for 3 rate cuts. Markets are calling for about 1 to 2 rate cuts. But the thing is that the Fed's median dot plot chart is actually penciling 2 rate cuts as well. One point is that probably rates are going to fall further. The next point is that maybe it may not be as fast. The third leopard is to actually inject and puncture the understanding against the market consensus of the higher, stronger US dollar. We have actually seen in the past that when Trump took over president in his first presidency, markets were roaring very quickly. You know, markets were like, wow, Trump is president. Trump is going to make America great again. Funds flew into the US during that period of time, and the DXY was very strong. That was then. If you're going to paint the same picture as it is now, we are basically merely reliving history, yeah, whereby markets are just reacting, towards Trump's victory in the elections, and that has pushed the dollar very strongly. But what has history taught us? History taught us that what goes up may not stay there. What goes up may come down, and that basically suggests, that the DXY, if you see the chart on your screens now, basically shows an inverted V shape for the DXY. It may stay elevated. DXY may stay elevated in the short term, but the fervor, the risk appetite may fade. Yeah, and that could mean that even if rate cuts come in as early as second quarter, it's going to curtail DXY strength in the second half of this year. Leopard 4, I think, and this has very strong implications for the global economy. Why? Because we have to remember that the debt ceiling was previously abolished, by Biden. It has expired, and Trump is trying to pursue the abolishment of the debt ceiling. Yeah, because he wants to spend more. Essentially, he has been shot down. He has been told by his House Republicans that no way are they going to agree on the abolishment of the debt ceiling, because there were no plans made by Trump to mitigate increased debt allocation and accumulation into 2025. So how painful it is for the debt problems in the US. Let's just look at numbers, shall we? One of the challenges that I face as an economist when I present to senior management and to our clients is that I have been asked, please quantify, the revenue from the tariffs. Yeah, because if the US does inject tariffs into the rest of the world and China, there will be tariff revenue. Yeah, for sure. Shouldn't be, and the question that was posed to me, shouldn't be the tariff revenue be able to offset the increased expenditure that Trump is trying to make? And the answer is no. No way. Yeah, the proposals that Trump is thinking of implementing is to extend job cut, is to exempt overtime income from taxes, is to end the taxation of social security benefits, so on and so forth. You can read it on the screen yourself. So if you look at the central tendency or the central forecast that is given by the US Committee of a Responsible Federal Budget, the increased expenditure is as high as 10.4 trillion. 10.4 trillion. And the revenue based on what is he's trying to get at will only offset by 3.7 trillion. Net, we are actually looking at a total net deficit impact of a ballooning of a further 7.7 trillion, in the US economy. Someone may ask, how big is that? How big is 7.7 trillion for debt? And that is actually 18 times, 18 times the size of Malaysia. It's 18 Malaysias, and that is huge. It's a huge and ballooning print when it comes to increasing the US debt and deficit impact during this term. The last leopard, before I move on to the Q&A, and is that we have to watch out for China very closely. You do not need to take my word for it. You can just take investors, global investors. What are they doing? Investors towards the end of last year were pulling their money out from China very, very quickly. The initial fervor, the initial risk-taking appetite that investors have on China in September, October during last year had faded very quickly, yeah, towards the end of last year. We can see that the Shanghai Composite Index for the property index declined very sharply. Property prices still remains low, yeah, and declining in fact for China. And for that matter, the China net flows on the right side of the chart has tanked very, very quickly. And in place of it, investors prefer US-centric assets. And why is that so? It's because not only property prices is of question, but essentially the debt issues is going to be the next key risk that China is going to face. Yeah, because of the lower interest rates that China has imposed, also for the fact that there is going to be, with property prices falling, the wealth effects are down. The debt issues, total non-financial debt, household debt, public debt, and corporate debt has all climbed throughout history, and especially so in the last 2 years. And this is an important print because when there is ballooning debt, and we can actually see this from other countries as well, that brings in another key risk as to how are they going to refinance into the future. Yeah, and this is a risk that probably policymakers as well as rating agencies will be looking at very closely for 2025. Okay, so probably let's just end very quickly on this. Allocation strategies, where should we invest? Winners and losers, yeah? We have to understand that probably Trump will target very sharply on tariffs on China and Mexico because they are the largest trade deficit countries with the US. But we may move away from having trade, the tariff impact may not be very, very drastic on US trade surplus economies like the Netherlands and Hong Kong. So probably that's where we should look at very closely. Yeah. Okay. Let's end here and probably let's just as what Alan said, at the start of the presentation, the whole point is to stay informed and probably stay invested. Yeah. Despite what has happened, the leopards are there. Just stay invested at this point in time. There is likely going to be some volatility in the first quarter. Stay informed, and hopefully the next time we speak, we have more information and more clarity from 2025. Thank you very much, guys.
Thank you, Barnabas, for that informative session. So feel free to put in your questions into the Q&A box, and also you can post it on Facebook. So while we are waiting, maybe I can start with a question from here first, Barnabas. So like you mentioned, with the world second largest economy also slowing down, will that impact Malaysia in a severe way moving forward?
Yeah, thanks for that. Thanks for the question, Alan. Yeah. So we are, as I mentioned, I painted two scenarios there. One is if ASEAN flies under the radar, and if China or if the US labels ASEAN as a rebadging hub for China. Let's just talk with the base case whereby it's going to be better for ASEAN, whereby flows flow in. We have anecdotal evidence to show, that Malaysia can actually be a beneficiary in the US-China trade tension scenario, whereby Malaysia is the sixth largest exporter of semiconductors in the world. We have really seen investment interest from companies, Intel, Infineon, AT&S, NVIDIA, making investments very strongly in Malaysia. What does this mean? It means that Malaysia is actually very well positioned in ASEAN to take advantage of the fund flows away from China and into Malaysia and ASEAN. Yeah. So we can see that at least at this juncture, if we are looking at the trade deficits with Malaysia, US trade deficit with Malaysia remains to be very small. And this basically means that Malaysia is small fry. Yeah, they are small fry when it comes to being targeted by the US. So less issue on that. And more importantly, we see that FDI inflows, yeah, from the US and China has doubled very strongly, doubled, in fact, across in the last 5 years. And it's important because then this basically suggests that Malaysia has been ramping up its relevancy in the global economy and in the semiconductors and manufacturing space, whereby investors are looking very closely on Malaysia on how to basically use this as a hub or as a investment destination to further their business prospects. But I think maybe the risk, yeah, Alan, thanks for the question, but probably the risk really is that Malaysia's trade exposure is diversified, but watch for potential knock-on impact from China, because China still commands about close to 20% of Malaysia's total trade. Yeah, and this means that the impact, second order impact from ASEAN into Malaysia as well is likely going to be seen if there's going to be a very huge pullback of trade demand and trade activities between ASEAN and China, and Malaysia will not be spared if that happens.
Okay. All right. The second question is that what's the reason that China they keep on printing money, but the economy seems like it's still very lackluster.
You are saying that why is China still printing money?
Correct. They are in the know that they are consistently printing money, but the economy seems to be still uh, a bit lackluster. Any reason for that?
I mean, I don't deny that they're printing money, but every country, every economy prints money. Yeah, so I don't think that is supposed to be an argument there. Yeah, the US prints money, Malaysia, Singapore, everybody, yeah, prints money for their own monetary conditions, for their own liquidity conditions. We have to understand that, and that by itself is also a policy tool to control and influence money supply within China. I don't think, yeah, that printing money is going to be an issue there, because it's a natural phenomenon or a natural policy move within the country itself. But let's just talk about China's health. I think despite the risks that I've mentioned just now, um, China's high frequency data towards the end of last year still remains to be quite supported. Yeah, we can see on the charts right here, retail trade, consumer confidence, unemployment rate still remains in healthy levels, and exports, at least towards the end of last year, still remains in expansionary territories after the slowdown in 2022 and 2023. So I think numbers wise, if we are going to exclude the tariff measures, China is doing well. Yeah, minus the property risk that we are seeing, and the debt issues that we are talking about. But at least the growth numbers are pointing up. The key risk, essentially, it's the tariff measures that is going to come in and will actually pull back Chinese growth with a very, very large extent if that's going to happen.
So in general, they are talking about China growing at about 5%, which sector you think will be the leading growth sector in China?
So for China, I think let's assume that there's going to be tariff measures. There will likely be increased tariff measures against China. And that basically means that the export and external industries are going to be impacted negatively. So probably the laggards will be the external factors. But I think the strength, as what any Chinese will tell you, is a very strong consumer market. Yeah, whereby if the consumer market still remains very strong, and there is the second largest economy in the world, in fact, in the world, consumption plays a very big role in pursuing and supporting growth. Growth is likely going to slow, but that means that if you still choose to invest in China, then probably maybe look at consumer related sectors, and that could be one of the key outperformer, if any, for China this year.
Okay, thanks for the answer. Okay, now we move to Indonesia. Wafi, you got any question for Barnabas?
Yes, thank you, Alan. Yes, I do have several questions from Barnabas. Thank you for the interesting last picture. Though I hope it's not in the gazelle that's the counter attack the lion, but the snake, the wood snake. So the first
Okay.
question is regarding the trade. One of your slides shows that the number from the trade deficit between the Chinese and the US. But and my question is, how big is the Chinese export to the US compared to the total Chinese export number?
Thanks for the question, Wafi. Um, I don't have the exact number right now. Let me get back. I understand the question. Basically, you are asking how big is the exposure of US exports, yeah, from China
Yes.
as a percentage of its total Chinese exports. I understand that. Let me get back to you. Yeah, I don't have an exact number on this. Yeah.
Okay, I understood about that. Because yeah, because we are talking about the tariff, right? And I think that's will show about how the Chinese market government will try to mitigate the risk from the tariff. And the next question is still on the follow up from the Chinese economic data. The latest data shows there is some increase in the trade balance in the China. Do you think it will persist? The trend will be stay positive going forward and support the I think the commodity prices will start going up, like the metals and then the coal. I think recently just rebound as well. Um, do you think the trade data from the Chinese will persist going forward, or is it one of things?
I think that it is important to stay cautious on China this year. Let me start with that. Yeah. And I think it's natural to be cautious on China because of what Trump is going to do. Yeah. There's this book that probably everybody may be wanting to read. It's called Death by China. Death by China, because it's essentially a book that is describing, how Chinese firms and supremacy is going to negatively impact the US industries. And this is what Americans may be believing in. And as such, the external negative impact that policies may have on China is going to be very detrimental to Chinese growth for this year. Now, bring this argument back to base metals, as what Rafi has mentioned. China remains to be one of the largest, if not the largest, consumer of raw to semi-produced materials, and that includes base metals. Yeah, China is the factory of the world, and because of this, if there's going to be a curtailment of Chinese exports and trade and manufacturing activities in China itself, then this basically means that by translation effects, there's going to be negative demand impact to base metals as well. Yeah, and that basically means that base metal prices may stay tame to lower for 2025, purely on the basis of falling Chinese demand for the base metals. That's one way to put it. But I think there is hopefully, that China maybe adopts the playbook by the US. And what I mean by playbook, probably QE, quantitative easing. If there's going to be further lowering of interest rates, they may pursue Operation Twist, to try to help the Chinese economy, and that could cushion the slowdown of base metal prices in 2025.
Okay, thank you, Barnabas. And the next question is regarding BRICS. There, I think lately there's an update regarding Indonesia and the BRICS, and the BRICS topic is quite heating up on the ground here. What do you think about this BRIC issue will affect the overall economic and trade data on the constituent country,
Yeah.
especially with the US?
Okay, that's a very big question, Rafi, but let me just break it down. Let's just start with identifying the BRICS. Yeah, and let's have a clear picture of what BRICS are. The BRICS as a region is nothing more than a fan club. It's a fan club. Yeah, why? Because it's just coming together to speak about, as a group, to say that, we are one group, we are friends, and we will come together to speak about global issues. That's it. Yeah. Are there trade agreements between BRICS itself? No. Are there investment agreements? No. It's just a list of countries in BRICS. And Indonesia joined it as a full member. kudos to Indonesia, and Malaysia for that matter. It's a friend lah, like a partner. Yeah, it's not a full member. It's just a partner, to the BRICS. And what I like to say in Malay is kawan. Yeah, kawan. Yeah, Malaysia is just kawan to the BRICS. There are pros and cons. I think probably if the BRICS eventually evolve into a stronger bloc to talk about trade, to talk about investment, to talk about privileges, trade and investment privileges amongst the BRICS, with China at the helm. And if it's going to have a bigger and stronger say within the global space, then good for you guys. We are not seeing this now. I think there are more risks, in fact, when it comes to being a member of the BRICS. And why do I say this is because Trump has been very vocal on targeting economies and regions in trying to undermine the supremacy of the US dollar. And BRICS is trying to inject its own currency, the BRICS currency, so to speak, to try to mitigate away from the influence of the US dollar. And if there is going to be any policies on that front from the US grounds to try to undermine the BRICS effort on that, then probably Malaysia as a kawan to BRICS might be spared. Yeah, but I think that currently probably that's less of a risk. It's just a fan club. I don't see any clear benefits at this juncture in joining the BRICS.
Okay, thank you for the explanation, Barnabas. And the next question is regarding you previously showed the slide about the outperforms and the underperforms indices around the globe, in the 2024. So what do you think in the 2025? What's the preference from the economic perspective among the countries?
Sorry, Wafi, I don't understand your question.
I think the question is which country will have the most potential in the 2025
Okay.
in the Southeast Asian, I think.
Okay. If then we shall go back to the base case and to the analysis that I've mentioned. So Vietnam has been very has very strong potential in benefiting in 2025. People say that Vietnam is China in Southeast Asia. They say that Vietnam is probably 10 years away from China, and Vietnam it's a country that has also benefited from Chinese flows into the country. This basically means that if there's going to be fund flows away from US and China into ASEAN, Vietnam and probably Malaysia and Indonesia will be very strong beneficiaries. Yeah, and that basically suggests that we will likely see winners, as I mentioned. Winners probably includes Vietnam, Malaysia, Indonesia, and Thailand. Yeah, but if there is going to be the blackest of swans or sizable risk whereby it's going to be a recessionary concern, then probably there are no winners at all. Yeah, probably. Yeah, but I think that Singapore may take the least of the brunt. Why? Because of two things. One, Singapore has a FTA with the US, free trade agreement. It's the only ASEAN economy that has a free trade agreement with the US. That's one. And two, Singapore is the only country whereby the US has a trade surplus with. The rest are all trade deficits. And this basically means that if there's any targeting of any measure of any sorts, Singapore may be not in the list at all. Yeah, so probably least of the brunt. The negative impact to Singapore will still be on the external front, but from the policy-wise, probably not.
Okay, thank you, Barnabas. I think that's all the questions I have for now. Back to you, Alan.
Okay, thanks, Wafi. Okay, got a few more questions, Barnabas. So let's continue with this from Liu Kok Ming.
Oh, yeah.
From Malaysia's perspective, against the backdrop of the RON 95 subsidy reduction, electricity tariff hikes, and weak external demand due to the escalation of trade war, what are the possible countermeasures that you can expect from the government?
For now, we are not seeing the potential slowdown in external demand. I think that probably there will likely be even a stronger trade prospects if there is going to be an increased partnership with China, yeah, on that. Yeah, and of course, if Chinese firms comes into Malaysia to produce and exports out from Malaysia, then probably Malaysia's exports on the medium term may actually improve. Yeah, so that's actually a good trend for Malaysia. But if that's not going to be the case, that would basically mean that probably the next countermeasure that the government may do is to lower interest rates, right? To cut interest rates by the BNM. Currently it's at 3%, and we don't discount the risk of lower central bank rates in Malaysia itself to try to counter against lower consumption and investment activities. The next that may do, if there is going to be a very severe, and I would like to re-emphasize very severe circumstance against Malaysia, then probably maybe there is going to be a delay in the fiscal consolidation measures in Malaysia itself, and that could actually delay the respective pullbacks or negative impact that these policies may have on Malaysia.
Okay, thanks. Okay, the next question is that so the US 10-year bond yield has been rising on the upwards, right? So what does that tell us, and what kind of opportunity that you think there would be in the stock market?
Okay, so the yield is rising in the US 10-year yields is because of two key factors. One, markets are pricing out rate cuts by the Fed. That's one. Two, demand conditions bond-wise are also declining. Yeah, there was this slide that I've showed. Maybe I just re-inject the slides one more time, whereby the bond flows into DM. Yeah, DM is developed markets, EM is emerging markets. Someone asked that in the chat box. It's also showing that there's a pullback in bond demand as well. Hence, US yields are climbing very sharply. This is now. What is important is what is going to happen into the future. In the future, we are pricing in probably rate cuts, and we are also pricing in probably that there may be some reversion back into bond flows as well. Suffice to say, the US 10-year yields based on a base case, it's very high. In fact, probably a bit too high. We may actually pencil in a slower US 10-year yield forecast into the year. How sharp? We have a forecast here, if I'm not wrong. Yeah. So 10-year yields, probably this may need a little bit more revision. Yeah, but we can see that the rate cuts in the US will actually start to pull the 10-year yields lower. As of December, before the sharp turn in the 10-year yields, we were calling for about 3.9%, probably a bit higher for now. But the thing is that it's still going to be a downward trajectory if we are calling for Fed fund rate cuts for the year ahead.
Okay, thanks, Barnabas. Okay, next question is that is asking how can we prepare for deglobalization if moving forward? Yeah.
What do you mean by how to prepare? I mean, I'm not so sure. I mean, it is happening. I mean, deglobalization. Maybe you're talking about an increasing changing of the world order, whereby investors are moving away from the dollar into other currencies. A breakdown of the world order, so to speak. I'm not so sure how to prepare. I'm sorry. We are not seeing this at the moment. I think probably, no, I'm not so sure how to answer that.
Okay.
No trends at this juncture. Yeah.
Okay, no worries. Thanks. What would be your outlook of the oil and also the gold sector?
So I think let's talk about oil first. I think oil, we are actually calling for Brent prices to be about $75 to $80 a barrel for this year. And this is also on the basis of potentially lower oil prices if Trump engages in fracking activities in the US to actually raise oil production and oil supplies. Yeah. The thing is that if there's going to be severe supply chain congestions, then we do not discount the fact that Brent prices might rally to more than $100 a barrel in the worst case scenario painted in this table. For gold prices, we think that probably in the first quarter it's going to rally further, despite the stronger dollar. And why is that so? I think it's simply because of some safe haven demand, whereby increased volatility in the global space may lift safe haven demand for gold. In the event if there's going to be a worst case scenario, as I painted in this table, we do not discount that gold prices will rise to as high as $3,000 per ounce. If there's going to be very strong supply chain congestions and risk aversion, and that could mean that gold will be the asset to go to, in terms of the worst case scenario. And if I could bring back the previous question, Alan, on how to prepare, that probably if there's going to be a deglobalization and a breakdown of the world order, then I think uncertainties will mean that gold prices, hard assets, quasi FX assets like gold might be very well demanded as well.
Okay, thanks. Okay, moving on. So among the Asian countries, so far STI seems like they are leading the peers. So what is the reason and how you foresee that the fund flow in the next first half of the year to Asia?
I think first quarter fund flows into Asia were still likely to be muted. I think fund flows will still continue to seek its grounds in the US, given that people will start be looking at maybe the pricing out of rate cuts, as well as what Trump may do to try to support US-centric growth, make America great again. And these are DXY and fund flows in the US positive factors that could actually play out in the first quarter. And this basically means that at least fund flows will prefer the US assets rather than ASEAN. But into the second to the fourth quarter, essentially, if there's going to be a trade and activities, rebasing away from China into ASEAN, then fund flows might start to come into the ASEAN space. And this basically means that the dollar might turn weak and ASEAN currencies might turn strong into the second half of this year.
Okay. What about the first part, which the question is that why is it that
Singapore
STI,
yeah, Singapore. So I think Singapore is a very special economy because Singapore's monetary policy, if we all know by now, is not an interest rate policy. It's a currency policy. Singapore engages in a senior policy band that has been supporting Sing strength, Sing dollar strength since history. And one thing that we recognize is that the Sing dollar, in this current time and age, it can be akin to the US dollar in a regional sense. Yeah, because people like Singapore. Singapore's, as an economy remains to be very transparent, as well as the growth structure has been quite resilient. And with the Sing dollar approaching, basically adopting the Sing dollar near band as a policy tool, as I just described, the model that we are actually pursuing basically shows that the Sing near is appreciating about 1.5% on an annual basis. And this means that despite all that happens, just policy maneuvers alone, the Sing near or the Sing dollar across the basket of currency is supposed to appreciate by 1.5%. And this is actually a very good appreciation rate in this time and age.
Okay, all right. Thanks for your answers to all the questions. I think that's all the time that we have for today. So on behalf of RHB Investment Bank, I would like to express our sincere gratitude to Mr. Barnabas Gan for sharing his valuable insights with us today. And also thank you for all your active participation and also all the questions. We appreciate your time and engagement. Please stay tuned for upcoming events and updates from RHB Investment Bank. So for daily market news and also insights, don't miss the RHB Morning Kappa at 8 your daily dose of financial updates. Stay informed, make informed decisions, and stay ahead of the market. So we look forward to welcoming you back in our future events. Have a wonderful day ahead and have a good trading day. Thank you.